Good morning, everybody, and welcome. Really happy to be here. This is the third year that we've done a similar speech, and every year there are more and more people. I'd love to think it was because of my sparkling personality, but I know better. It probably means that we've struck a chord, and there is a lot of interest right now in the car wash space in terms of it is a great time to consider selling a car wash right now. And not only are valuations at all-time highs, but the buyer universe is substantially more sophisticated and much deeper than they've been in the past. So when you look at everything has to come together at the right time. It can't just be a buyer and a seller. There has to be access to capital. There has to be a positive feeling about the economy going forward. And all the things are coming together at the same time right now in a way they haven't for a very, very long time. So that's going to be the message. We're going to talk about it in a number of different ways. We spent last year going over a lot of industry trends and why the M&A phenomenon was picking up steam. This year we're actually going to focus a little bit on that, but mostly it's going to be almost a how-to, if you will. The things that are important, who's buying car washes, why they're able to pay the kind of numbers that they're paying out there, and why they can still be successful. And then we're going to end up with some helpful hints, some things to look out for. Imagine one of the helpful hints, of course, is to hire us to help you sell your car wash, but we'll get to that as we go along. We're going to talk about M&A financing trends in the car wash industry. First thing we're going to do is we're going to talk a little bit about us. I can't possibly let an entire hour go without a little bit of a sale, but I promise that's not going to take up most of the time. We're going to talk about 2017, what some of the challenges were in the industry and what some of the good things were, and then we're going to talk about the current M&A environment. We're going to talk about sales considerations, and that's kind of what are people thinking as we go through the process. So when you have the private equity buyers, when you're approached by the big players, you know why this is funny? Nobody drives a Saturn anymore. It's ridiculous. So this is us. If you had asked me 5 years ago, George, will you be standing up on a podium giving a speech about car wash M&A? I likely would have said no. I'm really pleased to be part of the Commercial Plus team. There are 3 partners in our organization, and I think we bring something really unique. I've been doing investment banking, both on the buy side and the sell side for upwards of 25 years now. I have 2 partners who are in the audience, one of whom has been doing commercial real estate transactions in special purpose real estate, gas, C-store, and car wash for about 15 years. Our third partner is a licensed attorney who was a practicing M&A attorney for 10 years and has been doing car wash M&A from a legal and investment banking perspective for the last 10 plus years. So together, I think we bring a level of experience and professionalism that's a little bit different than the broker who's going to be selling the one-off car wash or listing it on Biz Buy Sell. We're accustomed to sophisticated buyers, we're accustomed to sophisticated sellers, and we're also accustomed to transactions in the 9-figure range as opposed to the 7-figure range. Although we gladly do the 7-figure ones as well. We are, happy to say, the #1 broker of car wash in the country. And that means everything from the one-off mom and pop shop that we sell to the major chains that we work with. And the advantage of that is at least twofold. One, we understand the industry, we know the players. 2, we have the experience because we've seen the pitfalls. And how does that work for you? Well, that works for you because we can market a car wash to exactly the right buyers in exactly the right way because we have the experience, we know what we're doing. Car wash relationships, we are very fortunate to have as our client base a number of the largest players in the industry. When you look at these, particularly Raceway, True Blue, these are organizations that didn't exist just a few years ago, and are now among the largest operators of car washes in the country. So when you think about what people are trying to accomplish in terms of growth, from whole cloth, people are taking chains of car washes, individual car washes, and putting them together in a larger organization, and it's been incredibly successful. And I know there are probably a number of you in the audience today who are trying to do exactly the same thing. So 2017, this is exactly the chart we had last year. And what we were talking about last year, when you think about the operational technological change, part of the reason that M&A has increased so dramatically is because of the move to FastPass, the move to the express model. A lot of the burden of operating a car wash, the employee base, the seasonality of the revenue inhibited people coming into the space. With those things gone, there are successful car wash operators we work with who have roughly half of their car wash revenue coming from FastPass or monthly membership programs. That means that on the second of the month, they're already in the black, and the rest of the month is just continuing to put more profit. That makes a business substantially more financeable, that makes a business substantially more predictable, and it's going to smooth those lumps that you used to see from seasons. Industry dynamics we talked about. We talked about the capital markets in some length. Capital markets were very loose last year. They continue to be so this year. There's always the talk about the Fed being concerned about an overheated economy, so raising interest rates. We've actually seen in the face of that, the actual rates have stayed the same or even gone down at the operational level. Talking about macro dynamics, we're talking about the economy. The economy is as strong or stronger this year than it was last. There is a little less uncertainty. We were very uncertain about what was going to happen with the taxes. We were uncertain what was going to happen with our new president. Like him or dislike him, we're not going to judge either way. There was a significant amount of uncertainty. Some of that uncertainty has been removed. So when you look at things from an economic perspective, we're actually in a stronger position this year than we were last. IBIS does a study probably every 6 months about the car wash industry. They were suggesting that we were going to do $10.5 billion in revenue in 2017. Actually ended up doing $11 billion of revenue. So they were substantially off in their estimate, that the market was meaningfully more robust than was the expectation. There were a number of large transactions done. Rourke Capital bought IMO in 2017. DRB was acquired. The Gugu was acquired once Rourke had bought. And National Car Wash Solutions and 48 car wash sites were acquired by Mr. Car Wash last year. So not only are we seeing M&A activity in the car wash industry, we're also, in terms of sites, we're also seeing an uptick in car wash industry M&A activity around equipment manufacturers or software providers. All right, so now we're going to talk about today. That was last year. So the M&A volume is strong. Effectively, the terms of number of transactions is down a little bit, but way up from historic. So there's a ton of activity, and when you look at the blue line, the average price per transaction continues to go up dramatically. The thing I find most interesting is when you look at the bottom. In 2013, there were 10 chains of 20 or more. There are now 22. It's more than doubled in that period of time. There were 33 chains of 10 or more. There are now 50 chains. And every day, actually, that number is changing and going up. So still a remarkably fragmented industry. When you look at the overall statistics, and there are 60,000 car washes when you take self-serve and in-bay and conveyor washes into account in the United States, and the largest player owns only 250. So when you look at it in that perspective, there is a lot of room left for continuing consolidation. General M&A activity is remaining robust. Deal volume is down a little bit from last year, but not materially. It's still, again, up from historical levels. And most importantly, when you look over to the right, values continue to rise. And when you look at the makeup of what is the acquisitions, debt is a substantial, representing just about half of the transaction. So half equity, half debt, which is, frankly, getting us back to 2007 kind of levels. Almost as though we didn't learn anything the last time around. So when we talk about leverage, 5.5 times debt to EBITDA. So what that says is that regardless of what you pay, so if you pay 9 times EBITDA for a business and you're able to put 5.5 times debt on it, it means you only have to come up with 3.5 times equity. So the higher that number is, obviously the more risk there is, because a highly levered business is much more susceptible to a downturn. But by the same token, less equity that you have to put in, and as a result, substantially higher returns. The leverage is really remarkable, and we'll go through a numeric example later. And you see the bond yields continuing to go down, what I was talking about before. Even though there's a consistent amount of chatter coming out of Washington that interest rates are on their way up, it really hasn't made its way into actual borrowing at this point. This is a great chart. Private equity, and we're going to spend a lot of time talking about private equity today because they are playing an increasingly important role in our industry. Private equity has almost $1 trillion that they need to spend. The way they get paid, the way they pay their mortgages, the way they afford their lifestyles is by putting money to work, not by collecting it and sitting on it. So to think that there's almost $1 trillion available for assets and the amount of interest there is in the car wash industry, interest rates are low, leverage multiples are up, it really shouldn't come as any sort of a surprise to anyone that they're interested in this space. So now we're going to talk a little bit about what if you are thinking about selling your car wash. So now is a great time, have you gotten the idea that I think now's a great time to consider selling your car wash? Well, these are the reasons why. Valuations are high, competition is increasing. I live in Phoenix and we operate out of Phoenix. It's a $3 car wash model where there are dozens of sites going up. There's a ton of activity, and at a certain point, the market's going to be saturated. And it's going to become more difficult to get the kind of returns that you get today doing a car wash transaction. As a result, I think, particularly in some markets, and this is geographically specific, the increasing competition is a great reason to think about selling today. The new buyers are sophisticated. They have access to capital pools that the mom and pop simply don't have access to, and strong macroeconomic and sector-specific trends. We'll talk about all of those things. Why are car washes attractive investments for people? Outstanding cash flow, high-margin businesses. Once you build a car wash, the people who manufacture the equipment for this industry do a really nice job. It's very durable equipment. There's a relatively modest amount of maintenance that's required relative to the value of the entire wash. Very little working capital, think about it, very little accounts receivable, almost no inventory. People pay as they come. It's a remarkable model that is very different than the rest of the world. Limited employees, particularly in the express model. Monthly passes will smooth your revenue. The real estate element, if you own the real estate that your car wash is on, it adds a very different dimension of potential financing options. There's lots of debt and equity out there. The market's fragmented and there are very low barriers to entry. You put all those things together and it's a market that is ripe for consolidation. I think about value and I think about doing a transaction generally in terms of a multiple of EBITDA. There are two elements to a multiple of EBITDA. There's the multiple and there's the EBITDA. It's pretty straightforward. The multiple is going to be driven in large part by multiple locations. You're going to have a higher number. Strong books and records, you're going to have a higher number. Local competition, if it's strong, you're going to end up with a lower number. Operating history, if you can show that you've successfully weathered 2007, 2008, chances are you're going to get a higher multiple. Where are you? Obviously, location, location, location. strong IT, market dynamics. These are all things that are going to push that multiple up or down. Some of them you have absolutely no control over. A lot of them you do have control over. It's funny to go into a transaction, and we look at dozens and dozens of car washes every year. And the people who are organized, who have the right POS system, who have their numbers that are straight, they've put add backs on there, but the add backs are defendable. They're not trying to add everything in the world back. Those are the people who are going to generally get a better multiple. So within your control is running or selling a clean business. The keys to a successful sale, I think the note on the bottom is one of my favorites. People coming in and buying your business know a lot more about buying businesses than you know about selling businesses. It's kind of the concept of don't take a knife to a gunfight. You want to make sure, and I'm not saying that they're necessarily out to get you, but what they are out to do is get the best transaction they possibly can at the best terms they possibly can. So understanding that and arming yourself in advance is going to go a long way. First of all, I'm a huge fan of competition. If you run a competitive process, you can go to bed at night knowing that you cleared the market at the highest price. That's how you maximize value. It's a little more challenging. There's a little more risk of people finding out what you're doing. But if ultimately getting the best price is what you want to achieve, that's the way to do it. Be prepared. Make sure that your numbers are there. It's all about understanding in advance what they're going to ask. Answer the questions they're going to ask before they ask them, and it pays dividends every single time. Have a realistic view of value. I can't tell you how many people, well, my neighbor sold for 14 times EBITDA, so that's going to be my minimum. Don't. First of all, your neighbor probably didn't actually sell for 14 times EBITDA. They're probably making that up. Or they sold 14 times 2006 EBITDA. It doesn't matter necessarily what your neighbor sold for. What matters is what the market is doing at this moment and what a realistic number is for your car wash. Have the data ready, make aggressive but plausible add backs. First horrible red flag is when you see an express car wash doing 75% EBITDA margins. Because you know that something is not being counted along the way. So my recommendation is show your real numbers and then put an add back line, explain what the add back is and why it's reasonable, and then show an adjusted number. You will still sell off of the adjusted number, but people won't feel like you're hiding something from them because you're not, frankly. Have all the data ready to go. Discipline in a process is critical. Being able to put things together, answer questions in a timely manner gives a buyer more confidence that they're getting the right answer, that they're getting it in a way that can be trusted. Be well advised. Again, I warned you that there would be commercials. We aren't the only part of your team. I think an investment banker is an important element, having done this a lot. But you also have an accountant, you have an attorney. Make sure, just because your friend Joe has been doing your zoning work for the last 22 years, doesn't mean Joe should handle the sale of your business. There are incredibly competent M&A attorneys out there. You need that. You need the right person in your corner. Insist on a strong NDA and know what they'll ask for. It's all about being prepared. So the biggest question to ask a potential acquirer as you are doing a transaction: do you have the money? This is the first, most important, and best question you can ask. There are a lot of people out there who want to enter the car wash industry who don't really have the money. What you don't want to do is tie up your site for some long period of time waiting for a transaction to happen that's dependent upon them going out and getting financing. There are a lot of people out there willing to buy car washes with really deep pockets right now. You don't have to do that. You don't have to wait. How much of a roll forward interest is required? What that is actually, do you have to keep equity in the business going forward? So effectively, do you sell 80% of the business instead of 100% of the business? Will you require a carryback note? You shouldn't have to, but sometimes In order to get a transaction done and in order for the leverage numbers to work and the return numbers to work, you might have to keep a note. Doesn't always have to happen, but it might. Who will manage the business afterwards? Is it expected that you're going to stay to manage the business, and is that what you really want to do? How much additional capital do you have committed? You do not want somebody spending their last dollar buying your car wash, particularly if you're going to have a role in it going forward. You want to make sure that they have enough money to keep it well maintained, potentially to go out and buy other car washes to build a chain. What's your investment horizon? If you are rolling money into this deal, you want to know when and how you're going to get out. It's a very fair question, very, very important. Is my stock the same as yours? This is my favorite. Sometimes people actually will require you to roll over 20%, but they'll give you different stock at a different price than what they're buying. So you're not really getting 20%, you're getting 15% or 10%. You need to make sure that that stock that you get is the same stock they get. And will I have to sign a non-compete? Meaning, if I get sick of you and quit, can I go build another car wash somewhere else? And do you, see, look, we're very insidious about the way we get our commercial in there. Do you have the right advisor? And, you know, no joke, we do believe we're the right advisor. I wanted to spend a little bit of time talking about private equity and how it worked, because they are a much, much more active part of how our industry is unfolding and are going to play a critical role going forward. When you look at the biggest players, you look at Mr. Car Wash and IMO, I call them hybrids. They're big enough now that you could consider them as strategic. They have their own management teams, they have a car wash business model that's set up, but don't forget, both of those are backed by private equity. They both started with private equity making an acquisition and building from there. When Mr. Car Wash was acquired by Leonard Green, it was a lot smaller than it is today. And when it was acquired by OnCap before that, it was a lot smaller yet. So we're going to talk a little bit about private equity. 2,300 private equity funds in the United States, from a few million to 24.7 billion. 3 phases of a PE fund. They raise capital, they deploy capital, and then they recover their capital. They tend to raise money from tax-exempt organizations. They raise money from pension funds, from sovereign wealth funds, from insurance companies who are looking to diversify their portfolios. Those are people who have just vast sums of money, and this is one portion of their investment portfolio that's riskier, but generally will have a higher return. And what do? They buy platforms. So a lot of good private equity firms think of a platform as a concept. They go in with an idea, what they believe is a dislocation in a market. There's a reason to believe that a particular market is going to do well over time. And they go in and they make an acquisition that serves as the platform for that acquisition. In this case, we can use the Mr. Car Wash example. Leonard Green bought Mr. Car Wash. They didn't stop. They've continued doing add-ons, one after another after another. So they have a significant amount of money, some of which goes to the platform, and then adding on to that platform as they go. And a little bit of that money goes to the PE managers. They are generally paid a management fee. Used to be 2 and 20 was the rule. 2% annual management fee and then 20% of the upside once the investors got a preferred return. And then they recover. They sell, they recap, they go public. Somehow or another, they get that money back. It goes back to the LPs with a return, and then some of it siphoned off to the PE managers who have done a good job for the LPs. So again, usually 2 and 20, they'd get 20% of the upside after a preferred return for the LPs. So why do you care about this? Well, there are a few reasons. One is they don't get much. Basically the 2% is what keeps the lights burning. So until this happens, the PE fund managers aren't really making a lot of money. So there is an incredible incentive to continue to buy and sell businesses. So there's a consistent stream of investments being realized. So what that means is there is a relatively short time horizon that private equity guys are interested, usually 5 to 7 years. And then variations on a theme, and we're going to see a lot more of this, I think, the family office. The family office is a concept of a wealthy individual who wants to put some of their capital to work through buying and managing companies. So it's a private equity fund, but it really is funded by one or a small group of wealthy individuals. And the difference for these guys is they can have a significantly longer hold period. There's not that same, they can take money out as they go, they can do dividends, they can do whatever they want. So there's not that same compulsion, if you will, to sell the business. So it's important when you sit down with people to understand, just because they're private equity doesn't mean they're all created the same. A family office is going to have a very, very different view of the world than a regular way private equity firm. And then our friend on the right used to be called the fundless sponsor, but that was too pejorative, so now they call themselves independent sponsors. They are people who have a lot of experience in the industry or a lot of experience in the finance industry, who find transactions and then try to get the money to make them happen. Interesting, because you can often get industry experts as the fundamental underpinning, which has value. Challenging, because they, by definition, don't have the money to do the transaction when they talk to you. I find in my experience, and to you independent sponsors out there, I apologize in advance, I find it's more challenging to get a transaction done because there is that extra step. So the transaction would have to be at a much higher price, or they'd have to be the only buyer, or one of a very select group of buyers, in order to make it worth that extra step of waiting, that extra uncertainty. So that's an independent sponsor. I did want to spend a little bit of time on sale-leaseback. I could talk about sale-leaseback all day, but I can also do it in 2 minutes. So what we're seeing more lately, you sell the building and offer a triple net lease to the owner of the building once you sell it, and the land offers you a triple net lease. So you are now, you've sold off your building, and you still own the business, and you still own that business cash flow, but you're paying rent to the new landlord. There is, for example, the Mr. Car Wash model. They do this on a routine basis. Pretty much everything they buy, and I'm going to get yelled at if I'm wrong here, they turn around and sell the real estate to a REIT who's in the business of owning real estate. They take that money and take their purchase price down considerably. Because right now, the cap rates, the market, cap rate is simply the percentage return you get on a real estate investment. So if you spend $1 million on a building with a 10% cap rate, that means 10% of the million is rent. You get a $100,000 return. You get $100,000 in rent. So right now, they can probably get between a 7 and an 8 cap rate, and that implies a 12 to 14 times EBITDA multiple on the land. And that makes the value of the business even if they pay 10 times, the value of the business all of a sudden is 3 or 4 times EBITDA they're in on an effective basis. Because Mr. Car Wash sells so many properties at one time or over time, the acquirers of those properties are able to diversify their risk effectively. So they are going to be able to get a lower cap rate, which is going to result in a better purchase price for them. That said, one-off sites are getting done all the time. In fact, we have one client who's doing one-off sites in the 6s. And the reason they're able to do that is because they're finding somebody on the other side of the trade who has a 1031 need. So they'll come in and they'll actually do an exchange into the property of our client, and they're willing to do that at a much lower return because of the tax savings that they're going to realize from that. So as a result, the one-off market is actually real. It's very powerful. If you buy a car wash for $4 million, you turn around and sell the property for $2,500,000. All of a sudden, you're in at 5 times. It's the ability to sell the property at a low cap rate has a high leverage impact when it equates to your ownership of the operating business. There are always pitfalls. One, you may not indeed find the right buyer for your property. 2, remember, you don't own it anymore. So it does become a little more difficult to sell the operating business going forward because you've already sucked the juice out of that deal. So the next guy who comes along is going to pay you a lower multiple because they can't do the same thing. So you get one shot at it. Although there are REITs that have a buyback clause, interestingly, where you can do a transaction and then buy the property back at a predetermined price 5 years later. Interesting twist on that. Well, I apologize for taking literally every second of my time. I hope this was at least helpful and interesting. Well, thank you very much.